Okay.
We got oil happening.
It's Wednesday. Let's jump over.
Oil got smoked yesterday.
It
man.
sure did. So some volatility this morning as well. I'm just going to close these out as we take a look at it. And yeah, so I'm going to open this up a bit. We'll find, so crude oil had spiked all the way almost down to $66 to back it up quite a day yesterday, right, that we saw to the downside. We were up at $69 early yesterday morning, traded below 66. We're currently trading at 66.80. We're looking at the December contract. I jump into the spreads here. So it's 10:21. We got 9 minutes until the EIA inventories drop. And we'll start things off with the 11 a.m.s, all right? See where these line up. Now, 66.75 is where we're sitting at right now. And we have spreads that line up, you know, within a penny, which is nice on the 11 a.m. basis. Now, just to take a peek, so here's our bullish spread, 66.75, and we can see the contract that we're trading is a few pennies above that. We're getting in at $22, which is the 22 cents above 66.75. And part of that, a couple pennies, is going to be intrinsic value, right? Because we're just above the floor of that spread. And then on the flip side, here's our bearish spread. We'll be selling that. It's going to be a little bit cheaper. So we're looking at about $40 for the 11 a.m.s, which you need about 40 pennies away from 66.75, which is kind of right where we're trading at, which is nice. We'll jump to
so it's 40 bucks.
40 bucks away from 66.75.
Exactly. Okay.
Now what happens is that the noons line up a little bit differently. They give us an option of 66.50. Just because the market's been jumping around so much, these are getting set every 2 hours when the market's opening. And so I'm just going to jump past them because, you know, 66.50, I mean, even the bullish spread, you're going to have to pay 26, 27 cents or dollars, however you call it, of intrinsic value. So it really becomes a bullish trade. We'll jump to some of these dailies and see how they line up. So the 8 a.m. to 2:30s give you 67. Again, you're 22 cents away. And then the dailies give you 66 as an option, which is where we were trading at last night. So really the pure volatility play would be the 11 a.m., you know, if you want to make that for $40. Because even when once you get into the noons, just to give what the trade would be, 66.50, there's your bullish side. You can see the bullish side alone is costing you $45.
Yes, right.
And then on the flip side, because you're pretty decently out of the money, once this loads, come on, this one's still costing you 12, so you're looking at 57 as opposed to 40. And if you ever got 33 cents of movement to the downside, you actually are your max loss. So it's not really a volatility trade, right?
Right.
Yeah. So we'll see what happens. We got 10:24. We got 6 minutes. Not bad in terms of, and as we're seeing this though, it's sticking around. It's 15 cents positive from when we started looking at it. But not bad when you've had this type of volatility over the last 2 days. About to get an inventory number in 6 minutes.
Right.
And you get to find risk.
I believe they, forget whether it was a build last night. We'll pull it up. It was a build or a draw. It was 9.5 million barrels, I think.
And, you know, if you're bullish or bearish, you could always just make one side of the trade, too, which is just to point out, you know, it's like, and what did I have the noons up here. But the 11 a.m.s especially, you know, you're waiting for trading at 66.80. There's your 66.75. And you're only getting in 17 cents above market for that type of defined risk of 23 to 177.
Right.
It is.
Gotta love it.
Yeah.
Welcome back, folks. Oil, what do we got?
We got the number. So oil inventories rising. Crude, 6.35 million barrels. Gas inventories falling, 4.83. I believe the expectation had been, at least from the Bloomberg users, expecting a gain of 5.7. So a little bit more oil than they had expected. We'll jump back to the chart. And, yeah, a little bit, well, no.
Look at that, a pop tire and then...
Yeah, so we were trading just about 66.80, and yeah, it jumped right up to 67.20 on that number initially, and we've already pulled back about 20 cents from that number. And again, to recap, the ones we were looking at, in particular, the 11 a.m. 66.75 would have been our point that we needed volatility away from. Yeah. So if you had some quick fingers, it did jump up there almost to a break even to the top side, right? You'd be needing about 67.20 exactly to the upside for about $45. It cost us about 40, so really 67.15, which is 40 cents away from 66.75. but that just got pulled back pretty quickly, and we'll see where that goes.
Telling you.
So essentially that one contract we were looking at had 66.75 and quite a spike to the upside right on the news, but in the last about half hour we've had, and these contracts we're looking at do expire at 11 a.m., so you'd only have about 5 minutes. Pulling right back to that 66.75. So that would be your max loss. You do have about $10 right now, so as in 10 cents away from that price point. So you would have some value upon expiration, but not the kind of action you'd want making a volatility trade where it was basically, you know, right where we're at.
And most times, too, when we do these, we have folks, you have the 11s and the 12s, so you just don't have one.
Yeah, and you had them this time. They just didn't line up in the same way. But yeah, because this market isn't going to stop moving at 11 a.m., right?
No,
we'll see where it goes.
There's no doubt.
Yeah.